Welcome to this explainer. Today, we're diving straight into Merck's Q2 2026 update to untangle, well, a really fascinating web of contradictory financial signals. Imagine bringing in over $16 billion in just 3 months, but at the exact same time, slashing your profit forecasts right in half. That is exactly the roller coaster Merck is on right now. It's this wild mix of beaten expectations, massive spending, and a literal landmark FDA approval. So let's just stick strictly to the data and figure out what's really happening beneath the surface of this massive organization.
To make sense of all this, here is our logical roadmap for today. We'll unpack the Q2 earnings paradox, look at the price of innovation, break down their post-Keytruda strategy, examine some real pipeline breakthroughs and approvals, and finally, look at Wall Street's verdict.
All right, Section 1, the Q2 earnings paradox. Strong sales versus sinking profits.
In the second quarter, Merck's top line looked absolutely incredible. They pulled in $16.6 billion, comfortably beating expectations. They even raised their full-year revenue outlook to a massive range of $66.3 to $67.3 billion. But, and this is the crazy part, on the exact same earnings call, they took an absolute hatchet to their profit forecast. They dropped their adjusted earnings per share guidance by nearly 50%, taking it from over $5 down to a range of $2.66 to $2.76. It is just a total reversal from the robust profits they posted in the same quarter last year.
So, the obvious question here is why? Why on earth would you cut profit forecasts by 50% when revenue is actively growing? How can a company that's selling way more drugs than anticipated turn around and tell investors that their profits are basically going to be slashed in half?
Well, that brings us to Section 2, the price of innovation and strategic acquisitions.
The short answer to our little paradox? Aggressive corporate shopping. Merck took a massive $5.7 billion R&D charge from acquiring Terrence Pharmaceuticals. In the pharma world, when you buy a company specifically for its pipeline, you usually have to write off those massive R&D expenses immediately. Add in another heavy charge for Cidara Therapeutics, and suddenly their quarterly R&D expenses skyrocketed to $9.7 billion. That's up from just $4 billion a year earlier. That is exactly why the bottom line completely evaporated. They are quite literally spending their cash today to buy the future.
But make no mistake, the underlying business is thriving. The sheer scale of the Keytruda franchise alone is staggering, bringing in an astonishing $8.37 billion in just one quarter. Actually, scratch that. Let me put that into perspective. That is nearly $100 million a single day. And the growth drivers stepping up right behind it? Just as impressive. Winrevair surged 75% to $588 million, reaching over 1,800 new patients in the U.S. alone. Welireg, a key oncology drug, grew by 67%. Even their animal health division brought in a very solid $1.78 billion. So while some older drugs face generic competition, their core commercial engine is firing on all cylinders.
Okay, Section 3. The post-Keytruda strategy and diversifying the portfolio.
CEO Robert Davis recently addressed the massive elephant in the room, Keytruda's looming patent expiration. For years, Merck has been viewed primarily through the lens of this single massive immunotherapy drug. But Davis made it clear, saying they've transformed from what was a Keytruda and vaccines company to now a company with 7 therapeutic areas. He's really pushing the narrative that Merck is no longer a one-trick pony. This isn't just a strategy pivot, this is pure survival.
You see, Merck anticipates Keytruda will lose its market exclusivity around 2028. That's the cliff they are rapidly racing toward. To avoid a catastrophic drop in revenue when generics hit the market, they're using the massive cash flow Keytruda generates right now to build an entirely new foundation. They don't just need one replacement, they need over 20. So those massive R&D charges we talked about earlier, they are essentially a down payment on a highly lucrative $70 billion commercial opportunity spread over the next 5 years.
Let's move to Section 4, pipeline breakthroughs and approvals, LP Fendra and beyond.
Let's look at the concrete solutions Merck just brought to the finish line, starting with a massive FDA win on July 16th. Now, to really appreciate their newest drug, Lipfindra, we first need to talk about PCSK9 inhibitors. These are incredibly powerful drugs that lower bad cholesterol. The catch? Traditionally, patients had to take them via injection, and as you can probably guess, most people aren't exactly thrilled about regular needles. That severely limited the real-world adoption of what is otherwise a truly life-saving medication.
Well, Lipfindra changes the game entirely. It is the first and only once-daily oral PCSK9 inhibitor approved by the FDA. by utilizing novel macrocyclic peptide technology, which, simply put, is a brilliant feat of molecular engineering used to shrink down a complex drug. Merck managed to formulate this powerful inhibitor into a simple, once-daily pill. It secured FDA priority review and literally completely removes the friction of injections for the patient.
And the clinical data backing this pill is nothing short of remarkable. In phase 3 trials, patients saw anywhere from a 56% to a 59% reduction in bad cholesterol. And we're talking about patients with inherited, incredibly difficult to treat forms of the disease. They didn't just make it a pill, they made it a pill that works exceptionally well. This opens up a massive new revenue driver for them as they look toward that 2028 horizon.
But it's not just cholesterol. The sheer breadth of Merck's pipeline is staggering. For RSV, the FDA just accepted their application to expand antibody protection for vulnerable kids under 2, with a target date of March 2027. In oncology, their antibody-drug conjugate posted positive phase 3 results for endometrial cancer. And in immunology, a new drug successfully met endpoints for both ulcerative colitis and chronic skin conditions. This right here, this is what transforming into a company with 7 therapeutic areas actually looks like in practice.
Finally, Section 5. The Wall Street verdict. Optimism despite the costs.
Despite a massive PE ratio sitting over 100, analysts are remarkably optimistic, and they are looking right past that 50% profit cut. Right after earnings, Daiwa Securities actually upgraded the stock to outperform. You've got JP Morgan, Wells Fargo, and Argus all maintaining buy ratings or raising targets, hovering right around $140 to $150. Wall Street clearly believes that the short-term pain of these billion-dollar acquisitions is going to be more than justified by the long-term potential of things like the Lipfendendra approval and this rapidly expanding pipeline.
Ultimately, this explainer leaves us with the billion-dollar question. Merck is spending vast amounts of capital today to buy the science of tomorrow. But will 20 new blockbusters really be enough to fill the void left by Keytruda, which is literally one of the best-selling drugs in human history? Or is a $70 billion pipeline just a high-stakes gamble against a ticking clock? Keep that question in mind as we watch their clinical trials unfold over the next few quarters. Thanks so much for joining me.